How to determine your monthly housing budget. When it comes to buying a home, you may be wondering how much you can afford. One main way to tell is by looking at your income and comparing it to the amount that you would like to borrow. In general, lenders want the amount that you spend on monthly housing costs, mortgage, property tax, and insurance to be 28% or less the amount you make in a month. As an example, if your gross income, amount before taxes and deductions, per month is $4,000, you can afford to spend $1,120 or less per month on your home. Another calculation that lenders use to determine how much you can afford is the total debt service ratio. This factors in your fixed expenses as well as your housing costs. Consider, for example, that you have an additional $350 each month in fixed expenses, debt repayment, other loans, etc. Add that amount to the $1,120 listed in the example above, and you get $1,470. This means that your total debt service ratio is 36.76%. In general, lenders want to see this ratio at 36% or below, so you may have trouble getting a mortgage in this situation. If you are planning on purchasing a home, it's important that you calculate these ratios yourself so that you have all of the information that you need before you apply. Calculating your monthly housing costs limits. The easiest way to see how much you are spending on housing is to add up your monthly income. This needs to be constant income. Add up your debt repayments. Calculate the total number that you spend each month paying a car loan, credit card debt, and any other loans that you have. Calculate what you are paying in housing. This will either be your monthly rent or your current monthly mortgage, property taxes, and insurance. You can then use this information to calculate the ratios listed above. Your housing expense ratio to gross debt service ratio is your monthly housing costs divided by your monthly income. Your total expense ratio, total debt service ratio, is your monthly housing costs plus your debt repayments divided by your monthly income. Improving these ratios. Budgeting and paying down debt. If these ratios are higher than the recommended amounts, you could be in over your head in housing costs. You may be handling the situation right now, but you could end up in trouble if you need to pay an unexpected expense or if your income changes. There are two main things that you can do to lower these ratios. One is to set a monthly budget and stick to it. This will allow you to save more money and build up an emergency fund in case you wind up with an unexpected financial obligation. Having a monthly budget and sticking to it will also prevent you from overspending and increasing the amount of debt that you have. Paying down existing debt is also a good way to improve your financial situation. If you stick to your budget, you will have more money, not just for savings, but also to pay down your debts. This will put you in a stronger financial position. For more money-saving tips, go to prudentfinancial.net.